Alright, I dare to say it. There are better ETFs than the S&P 500. While the king of all ETFs is recommended for almost every person's portfolio, I personally think there are way better alternatives out there, especially for dividend-focused investors. Today, I will show you an ETF with comparable to the S&P 500 results, but which crushes it in 4 very important ways. Which is this ETF, and what 4 ways am I talking about? Let's find out. First, a brief overview of the funds we will cover. Let's start with the S&P 500. I assume most of you know what the index is, so I will just say a few words about it. This is the index that follows the biggest 500 public companies in the USA, and the ETF that is constructed on it is the oldest ETF. The fund is often used as a benchmark that every other fund or portfolio is compared to. If you hear someone say the stock market did this or the stock market was up with X%, they most often talk about the S&P 500. At the time of recording this, the S&P 500 has the following portfolio construction. When it comes to sectors, the index is overweight technology, since these are the biggest companies currently in the market. After that, at almost equal weight, come the financial and healthcare sectors. Then we have consumer cyclical and communication at 10 and 9%, mainly because Amazon, Tesla, Meta, and Alphabet are in these 2 sectors. The holdings obviously change depending on when you are watching this, but currently they look like this. Microsoft is the top company, followed by Apple, Nvidia, Amazon, and the others. The fund is pretty top-heavy, with the 10 biggest companies comprising 1/3 of it, despite the fact that there are 507 holdings currently. Why are there 507 companies in a fund that follows the top 500 companies? I have no idea. I know someone will ask me in the comments, but I don't. Now, there is a common misconception that when you invest in the S&P 500, you are diversified because you invest in 500 companies. As you see, that really isn't the case. You invest in a fund with 500 companies, but 1/3 of your money goes to 10 of them. Whether that's good or bad, we don't have time to discuss here, but it's always something to remember. Alright, now let me show you our contender for the day. It's the Fidelity US Quality Income UCITs ETF, ticker symbol FUSD. The fund invests in companies from the USA with certain quality characteristics, which we will see in a bit. It is domiciled in Ireland and is UCITS compliant, which makes it available for European investors as well. It tracks the index by Fidelity, carrying the same name. This index, with everything I will show you in it, is the reason this is one of the best ETFs I have come across in all the years I've been investing. It's really a masterpiece what Fidelity have managed to create, so let's dive into it. The main screeners are income and quality ones. The income screener makes sure that only companies that pay dividends are included in the fund. This is a major difference with the S&P 500, where there is no requirement for a company to pay a dividend, which brings the total dividend yield down. But more on that later. Then we get to the meat of the index. What happens next is pure magic. Magic. See what I did there? The 3 screeners are quality-oriented ones. All companies that are selected initially are then ranked according to a score that is calculated based on these screeners. Each of them have equal weighting, which means that 1/3 of the quality score is calculated based on each. The first one is cash flow margin. This is a metric that shows how profitable and efficient a company is. Think about it this way. If a company makes $1 billion in sales of a certain product, but only has 100 million left after paying for everything they need in order to sustain the business, it is less profitable and efficient than a company that keeps 300 million from the same 1 billion. The second company will be ranked higher for this current screener. This ensures the companies in the ETF are profitable and efficient ones. The second filter also measures how profitable and efficient a company is. It is return on invested capital, or ROIC. It basically, to simplify it, calculates how well a company uses what they have as assets and money to generate profit. The bigger the percentage is, the more efficient the company is. It shows good management and higher potential for future growth, since there is more money left as profit generated per unit of capital. And the last of the quality screeners is free cash flow stability. This measures how consistent the company is in generating money, and so is an important metric for only choosing stable and strong companies. It is calculated over the past 5 years. Now, these 3 metrics are enough to ensure high level of quality for all the companies in the fund, and if there were no more filters, it would still be a pretty good ETF. But there's more. The following metrics are also included in the calculation of each score a company gets. First, price momentum, which gives the company a higher score if it has more momentum in the returns in the past year. Second, dividend payout ratio, which is the percentage of the profit the company pays as a dividend. It shows the sustainability of the dividend. Then it calculates a score for the dividend growth in the past 5 years. And lastly, for the dividend yield, which is a percentage the dividend is of the stock price. Now, with everything said this far, you can see how only very high quality companies will be present in the ETF. But as if it wasn't enough, there is more. Only companies that have grown or sustained their dividend at the same level for the past 5 years are allowed in the fund, which ensures that no dividend cutters will be allowed to creep into your portfolio. Then, the top 5% of companies in each sector with the highest dividend payout ratio are removed. This ensures even bigger sustainability of the dividends. If you're getting overwhelmed, don't worry, we are approaching the end. Please keep up with me here, as there are so many quality filters in the ETF. I wanted to show them all to you. Next, the 5% of stocks with the lowest momentum in their returns for the past 12 months are also removed. And lastly, companies that stop paying dividends from the ones which are already in are removed almost immediately, which is every month. A lot of ETFs wait for months and even a whole year to do that, dragging down the total returns, but FUSD does it every single month. I mean, just look at everything we went through. This Fidelity index makes sure only top quality companies go into the ETF by having so many checks and filters. Now, compare that to an index like the S&P 500, which basically has one filter. If the stock is big enough, it's in. Don't know about you, but I feel way more comfortable with an algorithm that calculates all the metrics we discussed constantly, keeping my ETF clean of lower quality companies, than simply a basket of stocks which are big enough to get into an index. For that reason, and because of all those quality screeners, which I haven't seen anywhere else, I have included FUSD as one of the ETFs in my top 4 stocks and ETFs free report, which you can get by going to the link in the description. It is a free report that will be sent directly to your email address. Now, have in mind that the report will always be up to date with the current environment because I'm constantly updating it, and since I have no idea when you will be watching this video, FUSD might have been removed by me. But at the moment of making and uploading this, it is there, and since the first time I included it in the report about 6 months ago, the ETF is up 14.85%. Of course, this doesn't guarantee future returns, and I'm not telling this to brag, but just saying that for a 6-month period, it's a pretty good result and confirms my choice to include it. So again, go to the link in the description and grab your other 3 stocks. Okay, now it's time to compare S&P 500 with the Fidelity US Quality Income ETF. You might be wondering, why am I comparing them at all and what are the commonalities between them? And this is a question I will answer shortly. But first, let's check the results. After that, I will show you the 4 ways FUSD is way better than the S&P 500 in my opinion. Starting with the total returns. Just a note, I will be using the BlackRock ETF on the S&P 500, which is why you will see ticker symbol IVV. The 1-year total return for the S&P 500 ETF is 26.27%, the 3-year 9.97% annually, and the 5-year 15.65%. For FUSD, those numbers are 19.16% for 1 year, 15.35% for the past 3, and 14.13% for the past 5 years. For the total returns, I will compare the cumulative returns of the funds since March 27, 2017, since this is when FUSD was created. As we compare the two ETFs, we can see that the S&P 500 leads in the periods except for the past 3 years, in which FUSD dominates with 15.35% versus 9.97% for the S&P. Now, let's turn our attention to the dividend increases. For the S&P 500 for the past 12 months, the dividend was raised by 7.91%, 5.30% for the past 3 years, and 4.44% for the past 5. For FUSD, the numbers are 5.26%, 5.56%, and 12.70% respectively. This is where you can see the quality factor coming into play. Over the past 5 years, the Fidelity US Quality Income ETF has increased its payments to its shareholders roughly 3 times more than the S&P 500. The reason I'm not going back more is that FUSD had its full year of full dividend payments in 2018 for the first time. Next, we go to the current dividend yield. For IVV, it is 1.33%, while FUSD's dividend is 2.20%. This is one of the big advantages of FUSD. Now, it might not seem like much of a difference, but remember, the difference between 1.33 and 2.2 isn't 87 basis points, it's 65%. This means that by investing in FUSD, you get 65% more current income on your money than you do by investing in the S&P 500. This obviously is a result of the fact that only dividend-paying companies are allowed in FUSD, while the same is not true for the S&P. The next important metric I want to look at is the max drawdown year. Since 2017, the worst year for both funds was the bear market in 2022. This is a great example which can show us how vulnerable the ETF is to market downturns. The S&P ETF lost 18.13%, while FUSD only 5.25%. This to me shows the bigger resilience and higher quality I get when investing in the Fidelity fund. The expense ratio for any major S&P 500 ETF you can find will be, of course, lower. For IVV, it's just 0.03%, while for the European domiciled and smaller FUSD, it is 0.25%. It's obvious that S&P 500 wins here, but I wouldn't worry too much since this is already reflected in all of the performance data we discussed. When it comes to holdings, the S&P 500 obviously has 500 companies in it, although, as pointed out, sometimes they are 507 and I have no idea why. For FUSD, the holdings are a lot less at 118 currently. Obviously, the S&P 500 has more companies, but 118 stocks isn't a small number at all. If you're finding value in this video, press the like button and subscribe by clicking the notification bell. That way, you will be notified directly when I upload new videos instead of waiting for the algorithm to show them to you. So now you might be asking yourself, why did I choose to compare these ETFs at all, and which are the 4 ways FUSD is better than the S&P 500? Well, the first similarity is the top sector. Both funds are overly exposed to tech, with the S&P having 30.84% in tech, while FUSD has even more at 35.56%. The next sectors, although not in the same order, are fairly similar. If you look at them side by side, the only notable difference is that in FUSD the communication sector is not well represented, whereas in the S&P 500 it is 9%. This is mainly because Alphabet and Meta are there, and one of them doesn't pay a dividend, while the other started only recently and probably still has not had the time to be included in the index reconstruction at the time of recording this. The next reason is that they often move in one direction in the same market conditions. When one goes up, I have observed the other does too, and it's logical having in mind the fact that both have the biggest USA companies in them. However, what you need to know is that when they go up, the S&P goes up more, and when they go down, it goes down a lot more. However, the amount the S&P goes up more with is less than the amount with which it falls, but I'll talk about that in a second. Third reason I wanted to compare them are that both funds rely mainly on capital gains for their returns, despite the fact that FUSD is a dividend-oriented one. So with all that said, I think it is normal to compare the two funds and perhaps view as redundant to have large chunk of both in a portfolio. This is where my thesis that FUSD is way better than S&P 500 comes. The first way it is better is that it gives you 65% more income despite having even bigger allocation to technology stocks, which are the growth engine of the economy. So you get kind of the best of both worlds here. You get the growth from the tech stocks, but way more income at the same time. I think one of the reasons for that is that 4 of the biggest stocks in the S&P, Amazon, Berkshire Hathaway, Alphabet, and Tesla don't pay dividends, and they are excluded from FUSD. However, I'm fine with that, since when I look at the top 10 stocks in FUSD currently, I see Microsoft, Apple, Nvidia, and Broadcom there, so 4 out of the 10 are huge tech names. Then you also have Visa and MasterCard, which are not in the tech sector, but we can agree they grow as if they are and are technology companies in their core. The second way the Fidelity ETF is better, in my opinion, is that it delivers superior dividend growth. If we go back to the comparison table, you can see that in the longest possible time frame we have, FUSD crushed the S&P 500's dividend growth rate at 12.7% versus 4.44%. As a dividend investor, this is extremely important to me, and so I would rather take that than the 18% more total cumulative return the S&P has delivered in the span of the past 7 years, which makes that less than 2% compounded rate per year. The third factor is safety. We already talked about the max drawdowns in a year, and you saw that FUSD is way less volatile in a down market, which helps you sleep better at night and also limits your losses if you're forced to sell for personal reasons. The reason for that lies in the fourth way FUSD is superior to the S&P 500, the quality of the companies. I have never seen an ETF with such an extensive list of quality filters which measure return on capital, free cash flow, profitability, efficiency, payout ratio, dividend sustainability, dividend growth, etc., etc. Usually ETFs would have 1 or 2 metrics to screen out quality companies, and that's it. However, we have almost a dozen here. And that's in complete contrast with the S&P 500, where apart from technical stuff like having enough liquidity, the only thing you need as a company is to be big enough and you're in the club. For all those reasons, I personally prefer the Fidelity US Quality Income ETF over the S&P 500. If you want to know more about my investing philosophy, want help with starting on your investing journey, or are interested in investing for passive income using dividend stocks and ETFs, I invite you to join my free investing masterclass, for which you can find a link in the description. Hundreds of people have already been through it, and I have had an overwhelmingly good response from the audience. With that said, after signing up for the masterclass, click on the video on your screen to continue with your investing education, and please bear in mind that this video is not a financial advice or a recommendation for you to invest in any of the mentioned ETFs. It's your money and you need to make your own decisions. Please check the disclaimer in the description.